Hey everyone, and welcome to The Explainer. Today, we're tearing down the walls on the absolute frenzy behind the AI infrastructure boom. The AI bulls can't explain this debt, and they absolutely know it. We're talking about numbers that literally break the historical scale and a complex financial structure that the broader market is completely missing. If you've been watching the headlines, you've seen all the euphoria around what AI can do. But today, we're going to dig into the math beneath the hype.
So here's the massive question we have to start with. How exactly is a $1.1 trillion infrastructure boom actually getting paid for? Because the answer isn't as simple as just looking at the cash reserves of big tech companies. There is a whole iceberg of financial engineering floating just below the surface, and what we're about to explore might fundamentally change how you view this current AI rally. Section 1. Bigger than Apollo combined. The historic scale of AI CapEx.
Okay, let's dive into this. Across calendar years 2025 and 2026, just 4 U.S. hyperscalers, Amazon, Microsoft, Alphabet, and Meta, are committed to dropping about $1.12 trillion on capital expenditures, and the vast majority of that is dedicated directly to AI. To put that completely wild number into perspective, in inflation-adjusted 2025 dollars, the Apollo program cost $189 billion. If you combine Apollo, the Marshall Plan, and the Manhattan Project, literally 3 of the greatest megaprojects of the entire 20th century, they total $362 billion. This AI build-out is dwarfing them by a factor of over 3. We are witnessing a sovereign-scale mobilization of capital, but it's being done entirely by the private sector in just 24 short months.
And this brings us to a really fascinating, almost completely hidden contrast. On one hand, you have the highly visible wealth, the huge operating cash flows, and the very public spending announcements from these hyperscalers. The market sees all that and feels totally secure. But on the other hand, to actually fund this $1.1 trillion sprint, we are seeing the rapid expansion of invisible, off-balance sheet shadow debt. And honestly, this is the central secret of our explainer today.
Section 2. $1.8 trillion off the books. The massive shadow debt of AI.
$1.8 trillion. According to a deep dive study by Morgan Stanley, that is the estimated scale of off-balance sheet exposures tied to this AI build-out. Just let the sheer weight of that figure sink in for a moment. This is essentially a ticking time bomb of financial commitments sitting entirely outside the reported public debt figures of the key firms involved.
Now, what's really interesting is how this $1.8 trillion is actually broken down. We've got nearly $1 trillion tied up in purchase commitments. So those are long-term procurement contracts for chips and infrastructure. Then there's over $822 billion in non-operating leases for data centers. And finally, roughly $110 billion in unpaid capital expenditures sitting in accounts payable, which means suppliers are effectively financing the build-out by waiting longer to get their money. These are legally binding future cash outflows, but they don't immediately hit the balance sheet as traditional debt.
To really get how this works, we need a quick crash course in accounting rules. Under current standards, a tech giant can sign a 15-year lease for a multi-billion-dollar data center today and report absolutely nothing on its balance sheet until the building is actually finished and the lights switch on years down the road. The exact same rule applies to purchase agreements until the goods are actually delivered. It's kind of like maxing out your credit card on a massive home remodel, but you don't even have to look at the statement until the paint dries. It's a totally legal accounting reality that allows massive financial obligations to remain practically invisible to the casual observer.
Because of this setup, the leverage is being aggressively shifted. Big tech is basically transferring this risk down the supply chain using complex special purpose vehicles, or SPVs. These opaque financing structures are being arranged by private credit heavyweights, think Apollo, Blackstone, PIMCO. The debt is ultimately being scooped up by bond funds, workplace pensions, and insurance portfolios. Meanwhile, if you trace the real numbers, hyperscaler gross leverage has quietly doubled from 0.9x to 1.8x in just 2 quarters, and global AI-related bond issuance has skyrocketed 357% year-over-year. The risk is spreading fast.
Section 3. The circular financing trap. Who is really buying the chips?
Let's move to and see how this actually builds, because the loop here is wild. Step 1. A tech giant invests billions into a shiny new AI startup. Step 2. That startup is practically required to take those exact funds and buy compute power or chips right back from that very same tech giant. Step 3. Private credit firms and SPVs step in to finance the remaining gap, often collateralized by the chips themselves. Step 4. This creates a closed loop of artificial induced demand that the tech giant then records as massive organic revenue. They're essentially underwriting their own demand.
Morgan Stanley analysts put it pretty starkly. They noted,
The circularity of the AI ecosystem further complicates adequate analysis. Basically, when the exact same capital just circulates repeatedly among a few key players, it becomes incredibly difficult to figure out what is real, broad-based enterprise demand, and what is just a vendor-financed feedback loop.
Section 4. Echoes of the telecom bust. History's closest private sector analog.
Now, if you want a historical parallel to all this, the late 90s telecom and fiber optic build-out is spot on. Back then, telecom carriers aggressively tripled their capital expenditures, heavily funded by debt and vendor financing, because everyone was absolutely convinced that internet traffic was doubling every 100 days. They ended up building a massive overcapacity of dark fiber. Today, we are looking at the exact same vendor financing structures and massive capacity build-outs in AI data centers based on similarly aggressive utilization assumptions.
Just look at the timeline. The telecom spending went into overdrive in 1996. By 2000, telecom equities hit their absolute peak. But by 2002, the capital cycle completely went bust. Major builders faced bankruptcy. Now here's the vital takeaway. The fiber optic cables they laid down, they were incredibly useful. They became the backbone of the modern internet. The tech was transformative and entirely real, but the equity holders, they were wiped out anyway. And as of 2026, that telecom index has still not recovered its year 2000 peak. The lesson here is that technological success does not guarantee investment success if the capital structure behind it is fragile.
Section 5. The looming depreciation cliff. When the accounting catches up.
Right now, a vast amount of this AI capital expenditure is parked under a classification called Construction in Progress, or CIP. Because these massive data centers aren't finished yet, they aren't considered active. That means they do not yet incur depreciation on the income statement. It creates what one accounting analyst beautifully described as a golden window where everybody looks good. Current profit margins are artificially inflated right now simply because the massive expense pressure is being legally deferred into the future.
So the crucial point is, what happens when that golden window finally closes? Morgan Stanley predicts that cumulative depreciation from Microsoft, Oracle, Meta, and Google will exceed $520 billion over the next 3 years. For Oracle, their depreciation is expected to leap from 7% of revenue to a staggering 28%. Meta will jump from 9% to 19%. Just to maintain their current profit margins when this accounting finally catches up with them, their revenues are going to have to increase simultaneously, and massively.
But here's the reality check. Is that massive revenue actually materializing? An MIT study just looked at 300 corporate deployments in 2025 and found that 95% of enterprise generative AI pilots delivered absolutely zero measurable P&L impact. Only 5% produced significant value. We are facing a multi-trillion-dollar monetization chasm. The infrastructure spending is just racing miles ahead of actual organic end-user demand.
To back that up, Nobel-winning economist Darren Acemoglu projects that, at current prices, only about 5% of tasks are actually cost-effective to automate with AI. The remaining 95%, it's just not worth the cost yet. This severely caps the near-term organic demand these hyperscalers so desperately need to cover their incoming depreciation hits.
Now, I want to be super clear here. We are not predicting an immediate solvency collapse. Amazon and Microsoft are absolutely not going bankrupt tomorrow. They have massive, highly diversified cash flows. What we're actually looking at is a severe structural crisis of timing. Investment is severely outrunning monetization. Leverage is quietly shifting into the shadows. And the accounting classifications are making it really hard for everyday investors to see the oncoming margin compression.
And here is exactly why this matters to you. This isn't just a problem for Silicon Valley equity holders. That $1.8 trillion in AI shadow debt, it's sitting right there in your corporate bond funds. Those complex private credit structures, they're being funded by everyday workplace pensions. The SPVs are backed by insurance premiums and annuities. This risk has been transferred out of big tech's clean balance sheets and woven directly into the broader global credit system.
Which brings us to one final unavoidable question. The data centers are being built, the off-balance sheet debt is locked in, and the accounting grace period is rapidly ticking down. When that depreciation cliff finally arrives, will the organic AI revenues actually be there to catch the fall? It's the multi-trillion-dollar question the market has to answer. Thanks for joining me for this explainer, and remember, always keep questioning the numbers.